With the stock market near all-time highs and interest rates higher than they've been for more than a decade, I can understand why a lot of people are not quite sure what to do at the moment. On one hand, you've got some of the best savings rates we've seen since before the global financial crash. And on the other hand, you've got a red-hot stock market fueled by a lot of excitement and hype around artificial intelligence. I mean, I bet if I just say the word AI in this video 10 times, the global stock market will probably go up by more than 10% this week. So what do you do? Well, let me break this decision down into 3 parts, which I think are the main things you have to consider before you decide to save or invest. I think the first thing you have to consider is time. How much time do you have available to put your money away for? Now, this part all ties in with the others, but let's just break this one down first. If you only have a year or two and you want to make the most of your money, then there might only be one choice that you can make. Now, I was speaking with someone recently on a one-to-one call, and they said that they want to buy a house in the next few years. But before that time, they want to make the most of the money that they had saved already, that deposit. So it was a big chunk of cash, and of course, it would make no sense at all for it to just be sat in a bank account doing absolutely nothing and losing value due to inflation as those months and years roll on. The only 2 choices were to save the money or to invest it. Now, with investing, the returns are typically greater, and we've just seen the stock market have a great year in 2023. In fact, the S&P 500 gained more than 25% last year, and even a global index fund delivered more than 15%. On the face of it, it's a no-brainer then. You should definitely invest your money because with saving, the best you'll get right now might be around 5%. However, the issue with investing is it's really easy to look backwards, but looking forward, there's no way to know what we'll get and nothing is guaranteed. Let me show you something interesting that I've used before in a video. If we go back over 100 years through the stock market, here's what the chances have been that we lose or gain money in any period. If we only have 1 year to invest, then 73% of the time we would have made money and 27% of the time we would have lost money. As you can see, there were 69 positive periods and 25 negative periods. It's not quite a roll of the dice like 50-50, but in my view, it's definitely quite risky to suggest that you can just invest for a year and make money. Also, don't forget that in any given year, the stock market is going to have some crazy swings up and down inside that year, let alone over a 12-month period. Now, once you extend your investing time horizon to 3 years, all of those numbers improve and you get 84% of the time making money with just 16% losing it. Then, as you can imagine, once you start going to 5 and 10-year periods, the numbers end up getting better. However, in this data, the 5-year numbers aren't a whole load better than the 3-year ones, so this does just show how much luck plays a role in what you could end up getting. Going back to the example then, if you wanted to save up for a house and you had a big deposit ready, would you save or invest if you wanted to buy that house within the next 2 or 3 years? It's a real tough one, but for me personally, I'd probably be more inclined to save that money using some kind of high interest savings account or even a cash ISA if the amount was so big that the interest might end up costing you money in taxes. I guess the only caveat here might be saying, well, you could invest it for the next 3 years and see how you get on, but you have to be prepared in case the market takes a turn for the worst. Either you remain flexible and don't buy a house until the market recovers, or you make a decision to pull your money out at the worst time and then move it to savings. For me, I think switching money in and out of saving and investing is just playing the market and not something I'd ever want to do. Just think, although 2023 was a great year for the stock market, remember that this was coming from a really bad year in 2022. I mean, that year was horrible for everyone, and it didn't even matter if you held stocks or bonds. In fact, some kinds of bonds, it was the worst year on record. There was almost nowhere to hide in 2022, and everyone got hit. So just imagine that you'd invested all of your money there for your house deposit, and then you see your cash down by 20%. I don't think that's a very nice place to be. Just on that note about investing, remember that if you do want to get yourself started and open up a stocks and shares ISA, I keep all of the links below in the description for you. There's free money and shares up for grabs, and I've even made a handy guide which I'll send to you looking at the best platforms. That link is also below once you finish watching this video. So generally speaking, investing works well when you have time on your side, and when we say long term, personally for me, I'd have to see 5 years or more at least to consider that a long-term investment. I think anything shorter than that, kind of 3 years and below, comes with a lot more risk. That's not to say that you can't do it, but you just have to be aware of those risks. Now, this leads us on to the next point I wanted to bring up, and that is risk. Now, this one is really hard to quantify because this one is going to be personal to you. We all have different levels of risk that we're willing to accept when it comes to making the right choices for our money. Saving carries with it very low risk, but in return, the rewards are fixed and they are typically a lot lower than you can get when investing your money. But with investing your money, there's a lot more to gain because you have to accept the greater risk. Over the long run, if you take the last 100 years as an example, the stock market, as shown here by the S&P 500, has delivered some pretty good results. Now, on average, the figures you see here show that over the long run, you can get around 10% a year if you kept your money invested. However, in order to get those returns, you'd have had to put up with some of the bad times as well, and there's no knowing when they will come. Sometimes, even when the stock market has done really well one year, it can still do well the next year. Other times, even when the market has had a really bad year, it doesn't mean it can't have another bad year straight away in a row. Just think back to the last couple of years, as I said earlier. 2021 was great with 26% in the positive. 2022 then flipped completely and lost you almost 20%. But then 2023 has done another 180 and brought great returns. And so far in 2024, touch wood, we're in the green. Now, all this shows is that we have no idea what's going to happen next. I remember 2022 well, and there were so many people in the comments of my videos and others saying that the stock market was still going to crash further, and this was just the beginning. There were so many people like that. I really wonder where these people are now, because I can just imagine them in a bunker somewhere, hoarding all their cash, waiting for that right time to invest. The truth is, nobody knows, which is why the rewards you can get can be really good if you have the patience and the tolerance for that risk. Also, on the topic of risk, you have to consider how you'd feel if you made an investment and then you see it dip down 10 or 20%. It's very easy to call yourself a long-term investor or quote Warren Buffett and say that you should be greedy when others are fearful and fearful when others are greedy. But doing something when the time comes or just saying you'll do it are very, very different things. It happens time and time again in the stock markets, and very few people are the ones making those moves when all hope is lost. I think it's always worth remembering that anytime you buy or sell an investment, there's someone else on the other side as well. Anyway, with saving your money, there's almost no risk, especially when you're talking about a high interest savings account or even a kind of a money market fund or something like that. But in return for that low risk, your rewards are capped and you know exactly what you're going to get. For example, right now you can find rates around 5% and you don't even have to lock your money away at all. So for every £100 you save, you can get £5 a year in interest. It might not be a 20% increase in a year, but it's a lot more reliable and you know what you're getting. So it has to come down to how much time you have, what risk you want to take, and then finally, I think for me, what you want to achieve. On this final point, I think this is a key part of the puzzle if you want to really get the right answer to this question. Ask yourself what you're trying to achieve. In the example before, if we look at that again, if you are saving for a house and you want to grow your deposit to buy a house within just a couple of years, you're probably not going to want to put all of that money into the stock market. You might decide to do it, but you'd be taking a high level of risk, at least in my opinion, it would be. And with that risk, you'd have to keep in the back of your mind that it might not work out and the stock market could ruin all of the plans that you had. If you can put up with that though, you still might go ahead with that risk. Now, a second example might be you want to make your money work for you in the long run. You've got an emergency fund, you've paid off your high interest loans, and now you're ready to invest. And your goal is that you're looking to build up a pot of money for retirement. Now, in this case, investing makes a lot more sense. If you understand the risk and you can stick it out for the long run, then you should do pretty well. In fact, if we do go back to some of this data, let me show you what's happened over different 20 and 30-year periods in the stock market. Here's a graph showing 20-year rolling returns. So if you pick any point on this, this is the number you would have gotten per year as your returns. You can see there's a really bad point here near the left side where you would have only got 2% returns per year. This is just really bad luck, I'm afraid, and this is what would have happened if you invested during the terrible period through the Great Depression and World War II. The rest of the chart looks pretty good though, and 90% of it shows returns of 7% or more. The highest point even gets you more than 18% per year if you manage to invest in 1980 and stop as we head into the dot-com bubble. Lucky you if you manage that. Now, just quickly, let me show you what 30-year returns look like. This is pretty much the end game when it comes to investing. If you have the time, you're happy with the risk, and your goal is to grow your wealth, then it doesn't get much better than this one. The lowest point on this chart shows you getting 7.8% a year, and the best point shows over 14%. More importantly, the long-term average would have been around that 10% mark, as we mentioned earlier. If you compare that to savings rates over the same period, you would have seen an average of less than half of that. If you take the UK, for example, interest rates set by the Bank of England have been anywhere from 16% in the late 70s to less than 1% for a long period after the global financial crash. As one final example, let me just show you what 5% versus 10% means if you invest or save over a long period of time. Let's say 20 years just for this example. If we put away £200 a month, here's what we would have got investing, and then here's what we would have got saving. So clearly there's a huge difference, and there's no guarantees what the future might bring for us either in saving or investing. But generally, if you want those higher rewards, then you will have to take a few more risks. If you have time on your hands, then clearly there can only be one real winner. I will just add a couple more things though. You don't have to pick and choose one or the other with this question. There's really no reason why you can't do both with a mix that's right for you. This is a personal question, and it does come down to what you're trying to achieve. Also, I've not even spent a second talking about inflation here either. And if I went into a bit of depth on this topic, I'd remind everyone that doing nothing is guaranteed to lose you money, as inflation eats up your money. So there's also risk there. You always have to take inflation into account, as this is the force that will destroy the buying power of your money. For example, right now, inflation is running very high, with the latest figures coming in at 3.8% from March. This means that if you want to keep the same buying power of £100, you'll need £103.80 to get the exact same goods and services from just 1 year before. This means that a 5% rate in a savings account will help you get there, but don't think you're making loads of profit here. In reality, this is just about getting you back to where you need to be. Now, I've done loads of other videos on my channel covering this and going in depth on inflation, but it is worth remembering why you need to save or invest in the first place. That's what you're actually trying to beat. Anyway, whatever you do, make sure that you do something and make the right choice for you. And for those of you wanting to invest, here's a guide to some of the best stocks and shares ISA accounts that you can use this financial year. And as always, happy investing.